U.S. inflation came in hotter than expected for January. Americans paying more for shelter, food, and energy. Joining us now to discuss what it means for interest rates and the bond market is Alex Gorewicz, VP, Director, and Portfolio Manager at TD Asset Management. Alex, always great to have you on the program.
Thanks, Greg. Great to be here.
We got a lot to talk about as well. It seems that in Canada, we sort of slayed the inflation dragon, but they're a bit stuck in the States. Let's start there. What do you make of today's report?
So maybe the way to summarize it is it's not looking great for the bond market, for the Fed, for probably just broader capital markets that have been expecting the Fed, even if they could stay on hold, would eventually, proceed with the easing path that they've been on since September. Today's inflation numbers are a little bit worrying, even beyond just the headline numbers. So whether it's the headline CPI month over month or core CPI month over month, core meaning you take away food and energy, which tend to be more volatile, markets were expecting about 0.3% month over month increase. Both of those numbers actually came in about 0.15 higher than that. So somewhere between 0.4 and 0.5 month over month. Now, that doesn't sound like a lot, I guess, on a monthly basis. If you were to annualize those figures, it's almost an additional 2% per year. Right? So I'm not saying that inflation monthly will stay this way for the next couple of months, but it gives you some idea about the magnitude of the beat. And then the year-on-year numbers were also firmer than expected. Now, when we look at the details, we know that shelter, yes, was a big driver of the beat. But even when you strip that out, so when you take core CPI, you take out shelter, we have what you call supercore. Supercore was the firmest it's been in over a year. So not a good outcome. It came in month over month at 0.75%. If you annualize that figure, it's over 9% per year. So huge number, right? Now, one number does not a trend make. So what has happened over the last couple of months with inflation? Unfortunately, that also doesn't look very good. Because for the last several months, whether you're looking at supercore, core CPI, headline CPI, all of the numbers over the last couple of months have been trending up if you sort of average them and annualize them. That's not a good outcome for the Fed, right?
Is this a case of the last mile being the hardest mile? I mean, it was up or 8, 9, you work down, you hit 3, and you sort of get stuck there.
See, I would have said yes if we continue to see stability in what we call the diffusion of inflation. In other words, the breadth, right? How many items in the CPI basket, whether it's good or services, are exhibiting, significant price pressures. We've seen some stability there over the last couple of months. Now, again, one number does not, a trend make, but now it looks like we're inflecting higher a little bit. I mean, in terms of the number of items that are growing above 2% year over year, or 3% or 4%. It's just overall, this isn't an inflation print that I think gives the Fed a lot of confidence that they're continuing on the disinflation path.
I'm looking for any updated comments from Chair Powell as he testifies. Apparently he's back live again. But of course, yesterday, before we got this print, he did say they are in no rush. There was a feeling in the market, and I know among some participants here in the bank, that, yeah, they were on pause for a little while. In the second half of the year, they would resume. We start seeing inflation prints like this. What are your thoughts on rates for the rest of the year?
Well, I could tell you the bond market's reaction was to price out almost a full cut for this year. So coming into the CPI today, the bond market is sort of evenly split between 1 or 2 rate cuts. We'll call it distributed throughout the year. Now the bond market is decidedly in the 1 rate cut this year and all the way in December. Of course, between now and December, a lot of things can happen. And I think the way to really read the market's reaction today is to say that at the moment, the data suggests the Fed doesn't need to cut any further. At least from the market's point of view.
I think, too, it was last Friday that we got the University of Michigan measuring consumer sentiment and inflation expectations as well. Because I know that when we embarked on this sort of inflation slaying journey, and it's been a long couple of years trying to get it down through higher borrowing costs, there was always a fear at the central bank, too. Not only what is inflation doing now, but what does the consumer expect of inflation 12 months from now, 18 months from now? That wasn't a reassuring print either on Friday.
I would take that with a grain of salt, only because we know that through a lot of survey-based measures over the last couple of years, a lot of partisanship has started to seep through. When you strip the Michigan inflation expectation pop higher into Democrats versus Republicans, Republicans expect 0% inflation growth over the next 12 months. Now, I find that highly unlikely as a development, right? And even the Fed wouldn't like to see 0%, right? They want 2%. They want their target, right? Whereas Democrats that responded to the survey, they saw about 5% inflation for the year. It's hard to really take, again, that headline or even the details in a sort of serious way here. Although inflation expectations are extremely important, I don't have a ton of conviction in using that as a gauge for what inflation will, how inflation will evolve this year.
Excellent insight there. I got schooled on that. I just
Sorry.
No, but this is why I have you here, right? Alex knows. So let's we put it all together. Obviously, we've seen a strong U.S. greenback. You look at the positioning in the U.S. dollar and what it's telling us.
The positioning is very stretched, just in terms of a lot of investors expecting upward pressure on the U.S. dollar. What's interesting about today's reaction is that it decidedly manifested itself through the bond market. In other words, interest rates popped higher. Again, investors priced out, that second rate cut for this year from the Fed. Whereas the U.S. dollar initially rallied across, a whole basket of developed market currencies, but has since faded to a degree. And I would say, if you look at the reaction function of investors around the U.S. dollar, let's say versus the bond market, it's been decidedly around government policy and in particular trade policy. So tariffs. Those have seemed to drive really big changes and really big upward moves in the U.S. dollar, whereas today's, we'll call it fundamentally driven, data point seemed to matter a lot less for the U.S. dollar.
Take it all, put it together. What does it mean for the bond market in 2025?
I think the bond market right now is giving the Fed flexibility because we have to remember, even, and you mentioned this, right? Even before the CPI print, the Fed was saying they're in no rush, right? This is what Powell's testimony yesterday suggested. They're in no rush to change policy rates. So in other words, they're staying on hold. This data point absolutely reinforces that. And the bond market has moved in that direction. What worries me is we don't have a clear picture around trade policy in particular and about how that will impact inflation when inflation is already sticky. So when we think about the next several months, if this sticky inflation persists, I do worry in a few months from now we'll start talking about whether it's appropriate for the Fed to raise rates again.